Hello and welcome to this amazing panel on how SIF strategies perform across market cycle. So we all know that SIF is a new asset class and we do not have any performance history so far. And in this context, it is very important to understand how you can evaluate SIFs, how it will perform across market cycle, and where does it fit into the client's portfolio. So to discuss about this, today we have Power Pack panel. We have Bharat and Rishi from AMC side. We have SIF expert Kiran, and we have Sudhendra from distribution side. So I'll start this panel with Sudhendra as he represents the distribution community. So Sudhendra, for years, we wanted a product that can reduce volatility without compromising much on return part. And boom, we have SIF now, right? So I want to understand whether SIF is all-weather solution or it is just another product.
I think it is a much needed product actually. Basically, I am a retail distributor, so where the ticket size of the investors crosses beyond 50 lakhs. So there the product, there's a gap was there where AIFs, PMSs are available, where people could able to, take all HNIs and, as Jayant was mentioning, the shout out was happening in the parties that I have an AIF, I have a PMS. There's no product was available for affluent people where there could be a different product altogether than mutual fund. So I think it's I can say it's a fantastic, like an IPL. It just something has come up in the middle where, exciting thing. I think it was necessary. I don't call it as another product. Of course, this is a very good fit, I can say, to the customer portfolio. I think going forward, it will become a part of most of the investors' portfolio. With the lower risk and higher return. So many mutual fund products which are just exist in the as a category, but is not sold or it's not been popularized. I think that which can be filled by SIF. I personally believe so. Yeah,
It will be all-weather solution according.
Kind of yes.
Yeah. As mutual fund fit into every portfolio, SIF also do.
Mostly yes, but there's a entry level barrier. So that actually adds. Do you get? I think I can say that more informed investor, there are experienced investors with mutual fund, this portfolio can be all weather for everybody. May not be entry point.
Great. So Bharat, I'm coming to you. So Bharat, recently Altiva has launched Equity X Top 100 and many fund houses have also launched Equity Long Short Fund. So I want to understand how Equity Long Short Fund will perform across market cycles.
So if you look at it, good afternoon everyone. Great actually to see a large presence and people trying to understand SIF. If you look at it, SIF from a broader perspective, one should think about SIF as a mutual fund 3.0. What is mutual fund 3.0? If you look at it, what is mutual fund 1 is the basic mutual fund, active funds which we are talking about. Mutual fund 2.0 is about passives, ETFs. Mutual fund 3.0 is the SIF, which is a mutual fund wrapped with hedge fund strategies with tight regulations. Tight regulation in terms of the way it has been structured. So you should think about this as a mutual fund 3.0, and I see a lot of people and it's a great crowd to actually that people are interested in it. On your question in terms of how equity long short funds should behave in different market cycles, one is to understand the SIF platforms can create different set of strategies within that bucket. So in a mutual fund avatar, you can place all large cap fund, all mid cap funds together. In an SIF format, all funds within the same category might not fit in the same logic. The reason why is that the SIF strategies can be created with a different views. For example, in an equity long short fund, someone can run a fund with a 100% equity exposure, because in SIF there is no need to short as a compulsory. You can run 100% long. It could be just a substitute for a PMS product. Somebody wants to run a mid cap, small cap, or more small capish nature PMS product, but on a SIF platform it's a tax efficient product. It can be done. So one can run a 100% equity product. So when you compare it, you have to look at it on market cycle. In a bull market, they should do well in general to that extent. But somebody could also run a strategy which could be 75% long, 25% short. This will have a net equity of less than 50% actually to that extent. So in that scenario, it should not be compared with pure equity funds. In a bull market, this strategy might not do as well as pure long only equity funds. While in a bear market, that strategy could do very well. the best time period for most of the equity long short fund is the time period where the market remains sideways. When market remains sideways, that is the best time for an equity long short fund to work around it. It's an interesting proposition because that is the time where many of the strategies on the long short side does very well. Another important aspect about equity long short fund is that whenever there is a lot of market dispersion, when we say market dispersion means there is a huge difference between a good performing stock and a bad performing stock, there is a time which the equity long short fund should do well. When market is homogeneous, when market is driven by a rally upside or downside, it's very hard to generate returns from a long short strategy perspective. It should broadly give you market related returns. So that's how it should perform across market cycles.
Great point that SIF will perform well during the bear phase and flat market. So I'll come to Rishi. Rishi, hybrid is one of the largest category currently. In the morning, Prem said that out of 13,200, 9,700 crore comes from hybrid category only. So I want to understand how hybrid long short fund will perform across bear, bull and flat market.
Yeah, thanks. Yeah, hello everyone. Good to see a packed house. So I think firstly, hybrid, fits that earlier speaker also spoke about that missing middle, right? And that was the real reason for, I think, the hybrid funds to really pick up to the larger percentage of allocations that have come in, because that was clearly a need. And right now it's very easy to discuss and relate to it because of how the last 2 years have been, right? Last 2 years, equity markets have not given you returns. Even fixed income has been very difficult in large parts of those 2 years. So right now, if you think about the last 2 years and say that, okay, you have a product which gives you a consistent, 9, 10, 11%, whatever, that will vary as per the strategy a little bit, but something which is arbitrage plus 2, 3%, right? Quite consistently with very low, very minimal risk. Then obviously, in the last 2 years, if you had something like that, it would have been a great outcome. And obviously, depending on the portfolio, depending on the risk you want in a portfolio, what you were saying earlier, that it's a potential fit in every portfolio, right? There is that 10 lakh ticket size, yes. So, whoever can do that, I think in all those portfolios, it's therefore a potential fit. And therefore, the real interesting thing is, one is obviously the tax, greater than 1 year, it becomes 12.5. So now you're getting a debt-like product or an debt plus arbitrage plus product at an equity taxation. So that becomes an even, bigger benefit, which was the issue with Cat 3 long short AIFs, where also the absolute return category had grown, but the tax used to impact it a lot, right? So that is the biggest thing. And then, of course, the expectation is like fixed income or arbitrage, it performs across market cycles or is almost all weather. Now, when we say all weather, it doesn't mean every month will be positive. And it doesn't necessarily mean every quarter will be positive. Also, I think for most of the hybrid funds that I've seen, there could be periods where, you could have 2 or 3 months, also being negative, but these will be small negatives typically. So really the goal is 9, 12 months and longer. I mean, typically 12 and longer because it again matches the taxation benefit as well. But at least 9, 12 months and longer. So I think anything for 3 to 6 months, you'll still, go to arbitrage funds and other things that you typically do. But anything that is 9, 12 months and longer is a perfect fit for this. And the goal is to perform across market cycles the way we have sort of designed it since our, NFO is starting next week. We are not live yet. But myself, there are many people in the team who have a lot of experience with long short strategies in the past. And therefore, what we've tried to do, we had a multi-strategy construct because there is no one strategy. And we all know this, how good the fund manager, how good the process, how good the returns. There will be short patches where, a single strategy will struggle. So no single strategy will give you the most consistent return and always be low risk. I mean, that would be magic. That fund manager would just, manage things on his own. And therefore, you want a multi-strategy construct, which is what we've tried to do. We've had 4 core strategies, not 1 or 2. And then the risk, because I think finally the positioning is really more about the risk. Now, if we say it's 1 to 3%, let's say, okay, it's sort of bordering on higher risk, but still, that range is the risk that I think, all weather products will have to stick to. The moment that 2, 3 becomes 5, 6, I think the positioning completely changes. You can't call it fixed income plus or arbitrage plus. So I think that is super important. And from our side, how we are addressing that is hedging the tail risk completely in whatever we can, in whatever way we can do, or not taking strategies that can take tail risk, not taking any open equity positions, because while you'll make money more on the upside, but then the whole point of the product is that in sideways to down markets you should make returns. So why should you be dependent on something that will make money when markets go up? Is our philosophy. Obviously, everyone will have different philosophies there. So these are the few things I think are important, and the attempt is to make it all weather, I think, for all the funds in this space.
Very insightful, Rishi. Kiran, so the industry does not have any debt SIF so far. So do you think that debt SIF can replace the traditional debt funds, which often struggle to beat the benchmark? Can it become a big thing according to you, since you have seen developed market as well?
Cool. Thanks for having me. Good afternoon, everyone. So I think Nishant always loves to put challenge. Out of all the 7 categories, SEBI has created only debt funds are the ones which are not yet live. So, but let's try to peel the onion here and then see, whether debt funds make sense or not, right? So the traditional mutual fund debt funds are long only, right? So how are they structured? Based on duration, credit, your curve positioning. But, it's also tricky to actually make money sometimes in debt. We'll take a couple of examples. So when the rates were like literally flat, somewhere around 23, 24 times. So the curve is, absolutely flat. So where do you make money? You can't actually make money there. You just only collect the coupon, and then the fund manager prays that, their whatever 40, 50 bips is not eating away their lunch. That's pretty much it. So there is nothing much to generate alpha there, right? So whereas debt SIF strategies, though it is little complex, we'll talk about that. But what SEBI has done is, SEBI is like, okay, why don't you, why are you just sitting on it? Take 25%, naked or unhedged derivative short, primarily derivative short here, if you're capable of, playing the debt product. So how does this work and when does this work? And I think Rishi was alluding to the fact that, fixed income, disappointed a lot of investors. I'm pretty much sure you got the complaint from, your investor base as well, right? What exactly has happened? Last year when the RBI started cutting interest rates, instead of, the yields going up, yields started falling down, right? It actually started somewhere around 7.4 G6 and then it almost touched 6.2, right? So how do you capture that? In the traditional mutual fund, long only, you cannot capture that, right? That is where the debt SIF comes into picture, where you generate that alpha. If you're a very skilled fund manager, leverage that opportunity and create your alpha. That's point number 1. Number 2 is, interestingly, you can also create alpha in corporate, debt as well. So just one quick example, during the ILFS timeframes, lot of NBFCs, which are even AA rated, actually underwent lot of stress. So what exactly happens in the traditional mutual fund? Again, the traditional mutual fund, you sort of reduce the exposure, but you don't play that, right? How do you play to generate that alpha? But whereas this debt SIF as a product will give you that opportunity to play and generate that alpha, right? So that's very good product. I think we are still waiting, wait and watch mode, on which AMC will come and how they wanted to structure and play this. But now having said that, I'll just make one point and pause. Debt SIF is not a replacement. Don't think it as a replacement to your traditional debt product. Something like if you have Ultra, right, money market have done exceedingly well in the last, 1 month to 2 months, right? It has given 15% returns actually, when the recent RBI policy has done. So don't think it is sort of an exact replacement, but debt SIF has to become your investor satellite portfolio, where if someone is looking to really generate that fixed income alpha and who have patience, who are ready to weather these, volatility, I think debt SIF is a right product. That is how you need to sort of position.
Great. So, Sudhendra, while SIF is the new product, the closest comparable is Cat 3 hedge funds, right? So I want to understand, but in the past, Cat 3 SIF have not outperformed mutual fund, as everyone knows. So I want to understand, why do you think that SIF can do well when compared with mutual funds?
See, first of all, it's early stage. First of all, to give you that perspective, you have to wait and watch. The closest comparison for long short would be, I think, Helios long short fund was there, one of the Cat 3, a very pretty old fund, about 15 years. I've seen the performance. I've sold also to the product. So there, the exposure limits were not there, only 100% has to be taken. They can take whatever they want. But the closest comparison is that. But the ticket size was 1 CR, and it could be modified accordingly. So I think the fund managers will come to a conclusion, or maybe a thin line where how we can design this without compromising on the standard deviation, where the whole purpose of this product is to make sure that risk is reduced. The only two ways you can create alpha: one, you participate in the upside of the market, or you can protect the downside. So I think upside of the market, mutual fund is anyway doing it. Downside protection may not be possible, and passive threat is not possible. 2.0 is not possible because it just participates accordingly. I think this product can actually add value on the downside protection by participating either by putting away from the benchmark plus taking short positions. I think I personally believe maybe 18, 20 more 4 months, what Vijayant was mentioning, we will have a edge where exactly this can play out well, and SIF can definitely fit to the ultra HNI to lowest possible part.
Great. So Bharat, So Bharat, typically equity mutual funds are for long-term goals, while liquid funds are for short-term goals. But SIFs are completely different product, right? So how can investors understand the product suitability and product knowledge in SIFs?
Okay, so if you look at it, yes, SIF is not a replacement from some of the equity funds. Equity funds is a more wealth creation. Somebody is thinking from a 5-year, 10-year perspective. Equity funds is the best option available. Go long on equities. Someone who wants to do an emergency fund, liquid fund is a better option. There's no doubt about it. There's no second thoughts on it. SIF, you have to take it from a two lenses perspective. One is it a substitute product or is it a supplement product? So you have to think from a perspective, is it substitute or supplements? What is substitute? Can I replace my CAT3 AIF allocation to some of these SIF or PMS strategies, which can be done in a tax efficient manner? It becomes a substitute product. You can do that substitution, and that is it. You can replicate the same strategies on the SI platform, and things could do better off from that perspective because taxation advantage is there. Second is the supplement product, where you can think about it, what I can do within the same setup. Can I reduce my risk? Can I enhance my return with the same risk? So those are supplement products which we can do. So an investor or an advisor needs to think about it. What are we trying to achieve with this set of products? And accordingly select the products rather than trying to say that this is black and this is white. This cannot be done. Each of the product has its own merit and advantage, and one has to think from that perspective. Having said so, it doesn't mean CAT3 AIF doesn't have an advantage. They have an advantage, which is what they can take a leverage. So I'm just saying this is a 1 crore ticket size. Somebody ready to take that leverage component at some point of time. That is a product for that kind of investors to that extent. So that's an interesting proposition in that bucket also.
Great. So Rishi, given the relatively brief history of SIFs, how can investors understand whether SIF will perform consistently?
Yeah, so I think just like, any other product you look at, I think obviously most important is, we're talking of many different categories, right? There's equity long short and there is hybrid right now. We will have debt and other categories also going forward. But more funds are there in these two categories. So even focusing on these, and again, within the categories, the strategies and the objectives are slightly different. Now, the hybrid ones are trying to be more consistent, what I already spoke about. But even in that, the strategy mix and all construct can be very, very different. In equity long short, I think there's an even greater variety of strategies and objectives that you're seeing. So I think first, most important is to understand that, right? Because if someone has a more aggressive or a more volatile strategy, but that is his objective, then it's fine. But if the objective was more consistency and something is more volatile, then, that is not fine. So I think there are a lot of nuances, and that is where the complexity comes in and where, all advisors like you are needed for the clients. So important to understand each fund specific strategy and objective and the risk management, most importantly in this product. Because again, if I start having risk, almost similar to an equity fund while doing an equity long short, and then the returns are similar, then the client will finally say that where is the positioning, right? I mean, I might as well do long only. So I think that becomes super important according to me. And in the past, even in CAT3 AIFs, we've seen people try to do, equity plus, equity minus, and the positioning, this exactly was the issue. And that is one of the reasons why we are starting with hybrid, because we have some excellent models we believe for long short. Again, people in the team have done it. BlackRock has done it. But we want to be very thoughtful because of this reason, right? And coming back to know how you can sort of address that. So one is understand that objective can be very different for each of the equity long short for sure. But even in hybrid funds, there can be a lot of variation. And then map that to the positions that you see, right? Every month and at least you see the positions. If people are talking about hedges, are those hedges there? Talking about how the exposure changes, is that happening month on month, or is certain buckets completely fixed all the time? Did they say it was fixed? So, typical things you would do in a detailed due diligence is something that I think should sort of continue at least for the first 6 months for any new fund. Please do that for us as well. I tell that everywhere. We are going to start next month, but we are going to be very, very strict on some of these things. And, that comes from a long experience on these strategies that we have. And then the risk management, I think we all focus on returns a lot. And obviously, if we are saying that, it's a greater than 1 year product, tax benefit will kick in, consistency will kick in, less than that may not kick in. Then obviously do your rolling 12-month, rolling 18-month, those kind of analysis to see, okay, is the objective being met 90-95% of the times at that time frame? Nothing will ever meet it 100%. But if it's greater than 90%, that's a great number. So do all that. But then I think risk is what we all miss. And for at least the hybrid part, which since we are starting, I'm more sort of focused on that. In both the categories, it is important, but even more important there, because as I said earlier, if 2% risk becomes 5%, then your positioning changes. So there, I think, if people are saying certain things are open, understand why it's open, how much impact it can have. If things are hedged, how are the hedges happening? Are the hedges, 3% out of the money on, say, a covered calls, sort of strategy? Are the hedges 6% out of the money? Are there no hedges at all? Are you taking that tail risk? It's important for you to know all of this, because, while tail risk events may happen once in 5 years, we all know that it will happen. We all speak of unknown unknowns. So the unknown is the reason why the tail event will happen. But the fact that it will happen, I think all of us who've been in markets for 15, 20, 25 years know. And therefore, we might as well protect for that, right? So in hybrid, I think that becomes super important. Equity long short, just to finish, I've highlighted what the issues can be, and therefore there I think the risk reward matters a lot. So at least if you're getting that return for a lower level of drawdowns and volatility, then I think it becomes very, very interesting. So focus on that.
Good point, Rishi. So Kiran, you have worked in the US markets in the past where SIF-like strategies are very prevalent. So how SIF have performed in US market, and what can we learn from them?
Yeah, cool. So first things first, I think the long short as a strategy will work. I think US has already proved that. So just to give you one quick statistic, if you take the entire cycle from 97 to 2025 recently, so the long short strategies actually outperformed S&P by 42%, with almost like only 20% as a sort of a drawdown. That means they were able to protect the drawdowns there, right? Let me not go too deep into US markets, but like what can we actually learn from, US to India and how India is uniquely positioned. So at this point of time, I think India is uniquely positioned from 3 different fronts, right? So the one, what we talk to investors is also, right, India is a very unique market, right? It's a very interesting market actually, because there is something called as dispersion, right? How many agree that dispersion actually is the oxygen to create alpha, right? So India has abundant, dispersions in various categories, right? I'll take quickly 3, right? One, if you talk about, the small cap, mid cap category, first of all, there is a lot of dispersion between mid and small cap. Even within small cap, 1 year you have, 65% return, another year you have 7.5% negative, right? So what is the percentage point that you're playing with? You're closely playing with 72 percentage points, right? So if the fund manager is so skillful, they can really play the dispersion and create an alpha for you, right? Whereas in US, if you see, the dispersion is not there now anymore. Between Russell, 5,000 and S&P 500, it's between only 0.7 to 0.9, right? So India still, it's an evolving market, growing market. We have a long way to catch up. The dispersion play is the really one which will create oxygen and create an alpha for you, especially in the equity long short. Point number 1. Number 2, we touched upon the debt part, so from 7.4 to 6.2, when the G6, the yields have moved, so much, again, there is like I won't even compare with US, right? US 10-year GSEC is 4.5. Now we are at like 6.8. So even if you compare that, there is a 230, basis points, of course, right? But within India itself, 7.4 to 6.2, there is again like, lot of dispersion that you have. Even within the debt market that you can play. That is point number 2. Number 3 is, interestingly, India is catching up, but still again a long way to go, is the corporate events. Fortunately, I think SEBI is doing a great job, these buybacks, QIPs, whether it is M&As, etc. and all. So how do you price it, right? If you talk about United States, say suppose if there is an M&A happening, whatever, everything will be priced within hours of time itself, right? You won't even have anything to play there. Okay. But whereas in India, it is still in a lot of evolving market, the market is still catching up. The institutional arbitrage is not that high. Institutional arbitrage is still like, catching up, playing, etc. and all. So you have a lot of play to play with this, buybacks, QIPs, offers, etc. The corporate events where you can play, right? Again, fortunately, I think SEBI has allowed, the, SIF fund managers to play those categories as well, right? So within these three categories, I would say, Nishant, right, equity, debt and corporate, you have a lot of dispersion to play with, and that is where the alpha is generated compared to the US market.
Great insights, Kiran. Brilliant, yeah. Sudhendra, yeah. So we have currently 3 broad categories and 8 different fund categories within that. So what are some parameters that we should keep in mind before deciding which categories to invest?
I think we need to come out with a risk-adjusted return kind of a model first. That's a base model. Because I'll tell you, as a distributor, the biggest challenge which I am continuously asking question is that how would I get the FD money? This challenge does exist, and it is a reality in India. How much ever you go and talk about, the money will go to gold, FD and real estate. Equity asset will come very less. The only way to crack that is to give that consistency return with the lowest possible standard deviation, low risk, high return kind of a model, where not necessarily high return, I'm talking about low risk with moderate return or consistency can actually break that. I think as Sir was mentioning that, the equity long short or a hybrid long short, each fund manager will definitely add value by looking at the skill which they carry. So somebody can run a equity long short only in mid and small cap, like a X100, or somebody can do with more short or maybe less short, only long. So these options would be difficult to do it in mutual fund, because it become a all-weather product. The second is that I think segmentations will happen. So we'll be able to figure out to give the product to respective segments of the investors, which we are unable to get. I'll tell you the same example of that gap of 50 lakhs to 1 crore and 5,000 rupees. It's a big gap actually. For a distributor like us, we go and meet. Getting 10 lakh rupees check, I can actually reach out to 1,000 people. Than getting 50 lakh rupees check, I can hardly able to meet people, because there's multiple bankers, other people are there in the game. So I think these segmentations will be get addressed, 1, 2, and the point is that the skill of the fund managers, and it will evolve over a period of time. That should be the solution for this.
Great insights, Sudhendra. Bharat, as the number of schemes are growing up day by day, how can distributors actually shortlist which are the good SIFs for them?
Okay, so great. Yes, 13 AMCs have launched 26 category.
20 have got the license.
License are there and start been UI. Yes. So one has to think from an advisor perspective on a 4-scale model in terms of how one should look at it. A, what are we trying to achieve with this product? Are we looking for growth? Are we looking for consistency of returns? Are we looking for lower drawdowns? What is the objective of what we are trying to invest in? So one has to understand, and hence advisor's requirement is pretty high in this. Hence the ticket size, and hence a lot of education awareness is required. Second thing is we have to look at it from a perspective, given that the strategy needs to be understood well. What are we trying to achieve within that bucket? How we are going to achieve? What are we doing in terms of strategy? Rishi pointed out some of the strategies. He also pointed out some of the strategies, especially on the special situation side and corporate action side. So you have to understand what are the sources of alpha, where is the alpha is going to be made. Third is that as time progresses, you will understand yourself in terms of, given that daily NAV will be coming, you will be understanding what kind of return ratio risk the strategy is actually saying versus what is getting developed. Finally, if you look at it, it's also about the team. It's the entire long short piece is all about people who is managing the fund. If you look at a normal long mutual fund space, there is a passive fund which doesn't require too much of fund manager expertise in general. Here you require a good set of team, and I'm just saying Edelweiss has been extremely pioneer in derivative strategies, have been doing a lot of things on derivative side. So one has to build that team gradually, think about it. It's an interesting proposition. Teams can deliver those kind of returns, and that is how one should think about it when thinking about advising any fund to any clients.
Great. So Rishi, yeah. So today's generation talk about red flags. Whenever they get into a relationship, they look at what are the red flags. So I want to know what are the red flags in selecting SIFs.
Yeah, sure. Great question. I think that should be the first question. So red flags, I think, again, I mean, I'll list down a few pointers, things that should be obvious, but I think in all our excitement, we end up missing a lot of these things a lot of times, right? So first is obviously the strategy. And, Bharat was talking about it, right? Different strategy sleeves, what do they do? I think I mentioned it also earlier, understand what that does. And then, of course, see whether there is a, what you globally call style drift happening or not. Is that strategy that is running a little different from what was mentioned earlier? I think that is the biggest red flag, right? And that can help you catch things very, very early, firstly. Secondly, risk, I already mentioned about it, but, you give me 10 hours, I can keep talking about risk. And that is the most important for this category, right? Understand where the tail risk is, and is that being addressed, not addressed. Even if you are comfortable, like I think some of the speakers said that, the positioning can be very different. You need to understand, Bharat also said, where it fits in and how it fits in. But if that sort of is deviating, right, the risk part is deviating, then it becomes a big problem. So understand that. And if you are going with a slightly high risk strategy, obviously it should fit into your requirements, and then be fully aware of what that means. So that I think is the second most important after strategy or style drift. Then the liquidity. I think liquidity is less focused on. And we all know that each strategy has a certain, scalability. And beyond that, it will be difficult. And that is another reason we've seen such strategies in the past, at 500 crores do well, and then at 3,000 crores or 5,000 crores not do well, right? Even in AIF Cat 3, we've seen that issue. Again, it links to what I said earlier that, no one strategy can be performing all the time. Even the capacity issue comes in there if that happens. And therefore, you do need multi-strategies, that are there, and you need to keep building on them. Again, if I have the best 4 strategies I feel today in what I'm launching, that doesn't mean those will be the combinations that will be there 5 years down the line. Intelligently, you'll have to keep adding things as you evolve, and obviously within the same objective kind of risk return. And that relates to the team, right? Again, so I agree again that the team becomes important because not one person will be again doing all the strategies, right? So we are doing things like collars and merger up and REITs and InvITs. REITs and InvIT speciality is very different from, the collars and the merger up part. And there are a few more strategies which we may have down the line. So that becomes very, very important as well. And then finally putting it all together, the differentiation, right? So, you may want to have 2 or 3 hybrid SIFs in your portfolio, or 2 or 3 equity long short funds in your portfolio. But then what is the differentiation between them? What is the correlation between them? Otherwise, what's the point? We might as well have one. So again, that I think is the last piece.
Great. So Kiran, I need one quick response from you. So volatility is actually good for SIFs, right? That is what we have discussed so far. But your website, SIF Prime, shows that some funds have given negative return despite of volatility. So why this is happening?
Maybe let's talk about equity, in a bit, because I think there is a gentleman who also wants to learn about equity long short, right? See, I think you need to understand equity long short, in 3 different ways, right? And I think the first statement that I'm going to make is equity long short is working. I think the SIF as a, strategy and decent fund managers have proved equity long short is working. I'll take quick couple of stats, right? So March is a brutal month for every one of us. Nifty 500 fell 11.5%. But whereas, some of the strategies in equity were able to curb it only to 6 to 7%. That means, of course, it's negative return, but we can say there is an alpha that is generated there. Point number 1. When there is a upward trend in V-shaped recovery in the month of April, The fund which has actually fallen 6%, can you imagine the sort of return it generated? It generated 15.2% positive return in a month. Okay, so that means the short, they were able to protect the money. You're down the drawdown there, and then when it went up, it was able to generate the alpha for you, right? And in the month of May, when the market was flat, these funds were generating anywhere between 2%. Okay, that's like point number one. To say that equity long short is working, okay, that is what this is very short cycle, to be frank, but within short cycle we can say that the strategies have proved themselves. But now coming to the point, I'll make a couple of statements here, just with a proper disclaimer. The problem with equity long short, I think the sir was mentioning also that most of the fund managers are still have that long term mindset. Okay, they need to come out of it. They need to accept and embrace the fact that there is a 25% short available for me. They will come there, right? But I think they are slowly playing the game. But also it comes with two challenges, especially in the Indian market, I think, which is what SEBI also has to come into picture. One quick point, right? The basis points. What happens in the US is, if you are shorting on the stock, okay? But in India, you are actually shorting on the options and derivatives, okay? So when X is falling, it is not proportionally falling there. Why? Right? There is a differentiation which is eating into your alpha. Okay, that needs to be fixed. Number two is, whenever there is a shorting in US, as a fund manager, if I'm a fund manager, I can actually make money because I generally get carry on the yield. Whenever I'm parking it with the broker there, right? But unfortunately in India, when you short, you're not making money first of all, but you are actually parking all your margin, whatever the SEBI span rules, margin rules, or whatever stuff, right? So it's a capital cost for the funds to start with, right? You are not even generating a single rupee, forget about alpha, and you are actually putting all the money there, as a margin. So that is little tricky point at this point of time. The fund managers are living up to that. But I think, these are some issues that are, able to figure it out, and I think they will figure it out. And I think we have very good fund managers in India, I think. Yes.
Great. So we are running short of time. So one quick rapid fire round that I would like to play. So then there is one suggestion for manufacturers like Rishi and Bharat to make SIF more attractive.
Yeah. No. Good. I think we should start, market in a different way so that you can say that this is for matured investors. One. Two, I think you should make them to understand it's not like a mutual fund, just jump in and do whatever you want. I think there could be small differentiation, giving the premium look, feeler to the investors can definitely add a lot of value, because here we are getting, don't look at 10 lakh, I can even get 1 crore check. So from the distributor point of view, I think now dynamic is coming, calculating the same thing. Now it's a part of our portfolio also. I think some manufacturers should come out with, like how mutual funds has become a normal thing. Some premiumization can be done. How, I don't know. I think maybe somebody should add.
SIF special hai.
Or special hai. Kuch to special hai. So I think it should.
SIF sabse sahi hai.
Sabse sahi hai. So maybe that is required, and also required maybe initial days of that AMFI clearing support was required from the AMCs, right? Similarly, we required an AMCs to take the responsibility to make sure a lot of people will get distribution, because the distribution committee is not there. It's difficult for us to scale the business also. I think that's also required. These are two feedbacks.
Great point, Sudhendra. Rishi, one thing that will determine success or failure of SIFs.
Yeah, so I'll answer that question, but I'll just finish up on what he just said, because something was in my mind around, obviously, education, right? More education and awareness is what basically the point he was making, and the certification, which has proved difficult for large sections of the market. So at least from our side, you will see a lot of that happening. So, my colleagues are there, we can discuss later, but we are going to roll out a lot of content. We know we want to do a lot of things very differently, not only in SIF, but on the long only side as well. And for that, we will need to come out with content. And with the SIF, of course, there's a lot of stuff that we can do. So both from a content perspective and from a learning or certification perspective, there are certain things, we are planning to do, which we would love to chat later. And then on the questions, the next 3 to 5 years, so I think consistency, returns, all that we've already spoken about a lot. So again, I'll touch upon a few things which, we don't always talk about, which is team, of course, but we spoke a little bit about that. And just to complete on that, at our end, we have not one, not two. There are like 4-5 people who've done long short strategies earlier. We have a whole infrastructure process. So apart from team, the infrastructure, the process, and finally the risk, which I harped upon a couple of times, but tools and mechanisms and infrastructure to manage and control that risk and really monitor it well. So I think these things, will define the success over the.
Great. Kiran, one key risk associated with SIF that you would like to highlight?
Key risk. Okay. Multiple risks, but I think I'll pick up what Rishi alluded to before. I think one key risk could be the liquidity risk, especially given there are some niche strategies, that has been rolled out. For example, REITs and InvITs, right? So, and also, like, for example, like, the NAV that you see, might not be the NAV that when you exit. Okay. So, and also when the another point was, if the fund managers have to do like, lot of shorting, etc. and all, India still has to evolve, to be frank. There is a lot of liquidity that is required, especially in, we come a long way from the indexes front, but I think from the stocks front, I think we need more and more liquidity is what I would say. For now, I think liquidity risk, I won't call manager risk, it's manager skill set which is required, for SF.
Thank you. Bharat? Yeah. So one strategy that every MFDs in this room should explore.
Okay. To select the one child
Category.
Okay. So if you look at it, currently the problem is if you look at equity investment, you have a lot of options available, right? From large cap, mid cap, small cap, you have option available. If you are some conservative investor, you have options in even the hybrid category, equity saving, balance advantage, aggressive hybrid funds, you have those categories. But when you come to fixed income opportunities, there are very less opportunities how to work around it. And hence, I think hybrid long short fund where somebody is positioning themselves for more fixed income like outcomes can be a strategy. One should look at it very, very aggressively. This is a size scale where people can deploy a lot of money. Fixed income money can flow through it at some point of time. If somebody understands this is a strategy which on a 3-year rolling basis can deliver better set of returns as compared to fixed income products or some of these hybrid strategies, it's an interesting proposition. So if somebody wants to select one today, as of now, the market is available for this hybrid long short fund strategies.
Great. All right. So we have come to an end to this interesting session. Thank you so much, each one of you. You have given so much of invaluable lessons to us. A big round of applause for this amazing panel. Thank you so much.